All right, we're at the top of the hour. We're going to get started here. Good morning or good afternoon to everyone. Thank you for joining. On behalf of your Baird Financial Advisor, I'm excited to welcome you to this month's Baird Wealth Strategies webinar. Today, our topic will focus on understanding the basics around transition planning for business owners. To discuss this topic, I'm happy to welcome Managing Director and Head of Baird's Business Owner Solutions team, Andy McKay. Andy has over 35 years of experience in executing middle market M&A, investment, financial, valuation, and other business transactions. Prior to joining Baird and leading the Business Owner Solutions team, he was head of investment banking at Hilliard Lyons. Andy is a member of the Kentucky Society of CPAs. He's accredited in business valuation by the American Institute of Certified Public Accountants. Andy is a board member of several closely held and family businesses. He has a Bachelor's of Science from Georgia Institute of Technology and a JD with honors from the University of Georgia School of Law. Andy, we're excited to have you here and thank you for joining us. So before I turn the call over to you, sorry, but before I turn the call over to you real quick, I just want to go over a few housekeeping items as we've all been in this virtual environment probably for quite some time. Just want to remind everybody for optimal viewing, we suggest setting your layout to the side-by-side view via the circle in the upper right-hand corner of your screen. All participants are in listen-only mode, but we'd really love to hear from you. So we'll host a Q&A session at the end of today's call and address as many questions as time permits. You can submit a question by clicking the Q&A button on the bottom right-hand side of your screen, but please be sure to address the questions to all panelists. The presentation is being recorded and will be made available in about a week following the call, along with the slide deck that we'll walk through today. So with that said, Andy, if you're ready, I'll let you take the stage.
Thank you, Justine. It's really nice to be here, and I look forward to having a conversation with everyone today about transition planning. The Business Owner Solutions team at Baird is here to support our financial advisors and their clients and relationships with respect to their businesses. And we effectively do three things. I sort of describe it as helping business owners figure out what to do with their business, helping business owners understand the value of their business, and then helping business owners navigate the process of transitioning out of their business, whether that be to family, third parties, which could be a private equity fund or a strategic buyer, or in some cases to employees in either in a direct transfer or what we would call an ESOP or an employee stock ownership plan. So I'm just going to spend a few minutes and just talk about the basics. I do encourage your questions, and we will save some time to try to answer those questions. And we're always available to answer any questions anytime, and happy to talk to any business owners. It's really what we do at Baird, and we enjoy what we do. So with that, I'll jump into it. So transition planning is really what we think of as a roadmap to help a business owner sort of maximize their value from their business. And in many cases, it is the most significant asset in their portfolio. It generally provides a large source of their income, but it is an asset that to a certain extent is illiquid because it's not one that you can mark to market or sort of figure the value out. And it's also one that is sort of difficult to monetize. Unlike a stock or a bond, you can almost get instantaneous liquidity. In many cases, it can take several years to sort of go through the process of realizing value from it. And what we think transition planning does is it really helps business owners have more control over their destiny, provides a path to retirement, and certainly some peace of mind. And if done and started early enough, an opportunity to maximize value from the business going forward. So, like a lot of things, when people are involved, we sort of put off sometimes the difficult things. So many business owners just don't start planning for their transition early enough. Why not? In many cases, it's emotional. It's viewed as sort of the end of their business career, and they don't want to face that. You can kind of think about it like decisions around maybe purchasing long-term care insurance or estate planning or end of life documents. We are all notorious for postponing and putting those things off, but they can be extremely important. Transition planning also takes a lot of time. A lot of business owners work 60, 80 hours a week, and they are more focused on what's happening today and this week and this month than what's happening in 5 to 10 years. So it's something that tends to get pushed to the side of the desk and not addressed. And in many cases, it's just complex. It requires a multidisciplinary team to do it effectively. And it is sometimes things that are hard, we tend to put off. So there are really, we think, three primary concerns of business owners, and that is really transitioning on their timeline. So you have to face the fundamental question, how much longer do you want to be involved in the business? What happens in the event of some unplanned illness or health concern? Second big issue is creating financial security. So if the business is providing and supporting the owner's lifestyle, how much money is needed if you transition out of the business to maintain that lifestyle? And what role does the business owner want to continue after that? And then finally, preserving the legacy of the business. Business owners in many cases have spent decades building a business, and they've hired every employee, and they've built this culture, and it's important to them that the legacy and what they've created continue. And in some cases, you have to balance that against maybe getting the absolute top dollar for the business. So these are hard questions for them to address. From a timing standpoint, it takes a while, and optimally, we think it's a 2 to 3 year process. One, putting a plan together, and that can take 3, 4, 5, 6 months in many cases. And then when you start thinking about getting the business ready to be transitioned, and particularly value enhancement, many of those changes in the business can take 6, 9, 12 months. So you've got another period there that can really come into play. And then finally, the process itself can take anywhere from 9 to 18 months. We typically tell business owners that are contemplating a sale when they're kind of ready to do something to plan on 6 to 8 months. It's not uncommon for them to take longer. It's pretty rare that it's less than 6 months. But so it is a long-term process which needs to be built in the lifestyle. Next topic is really assembling the right team. It's an all hands on deck approach. I think done correctly, you need 4 or 5 professionals in working together. From our standpoint as an M&A advisor, sort of understanding valuation and transaction process is critically important. You certainly need a good attorney, a good estate planning, and if there is a transaction involved, you need an experienced M&A attorney. We believe that's critical in successful transactions. And then from the financial advisor standpoint, it entails comprehensive personal financial planning, retirement planning, in many cases, insurance is part of that. The CPA is critical in looking at making sure the financial statements are in good shape and working on the tax planning that can really have a huge impact on after-tax proceeds. And then finally, an insurance professional to make sure that all of those items are the I's are dotted and the T's are crossed. And then someone that has to sort of drive this overall effort. So let me switch gears a little bit and talk a little bit about business value and the questions that we get on a regular basis. And the first one is, what's my business worth, and can it really fund my retirement? And those are not easy questions to answer, but with a little work, you can usually get pretty close. And then another question we get a lot is transferring the business to family members or heirs, and how can you accomplish that? And then the other question, sometimes we get too late. They want to know how to increase the value prior to selling, but they want to sell next week. So that question is better asked early rather than later. So it's just what we hear from clients. I'm going to talk a little bit about valuation. I've spent 25 years in the valuation world. And first thing I want to say is that valuation can vary significantly based on context. So for example, I had a client one time tell me he had his business valued, and he gave me a copy of a valuation that he had done in his divorce proceeding about 7 years ago. Now, I had two observations on the valuation. Fundamentally, one, it's 7 years old and a lot's happened, but I guess a little less directly, it was done from the context of a divorce. So it was probably done with a view from his standpoint of having an expert do a report to minimize the value as opposed to the full value. So you have to be really careful and understand that any valuation that's been done can vary based on the context and the purpose. ESOPs, employee stock ownership plans, require fair market value that meets Department of Labor standards, which is pretty close to the normal fair market value standard you might see at a valuation. But if, for example, the business is going to be sold to a strategic buyer, that fair market valuation will ignore any synergies and premiums that a strategic buyer may be willing to pay. If you look at estate planning, in many cases, the goal is to minimize the value of the estate, therefore minimize the estate taxes or gift taxes. And so the valuations will have all kinds of discounts and those kinds of things. So when you think about valuations, you just have to make sure that what you're dealing with makes sense in the context. So to really understand value, fair market value is the classic willing buyer, willing seller, given knowledge of all relevant facts and circumstances, and neither party being under any compulsion to purchase or sell. So it is a theoretical estimate of the true market value. Investment value would be the value of a company to a specific investor or buyer. For example, a competitor may be willing to pay more to get the company out of the market, or it could be to an existing family member. So it's, again, you have to pay attention to the definition of value and the purpose of the value. And then the other thing I would, a liquidation value or a value based on the assets. So if you took the balance sheet and subtract the liabilities from the assets, is going to give you a liquidation value. And those only make sense in situations where the business is worth more dead than alive. You might see that, for example, if the business owns a lot of real estate, that if you liquidated the real estate, you would end up with more money than if you sort of continue to operate the business indefinitely. So where can the businesses go? First, to family. A lot of great family businesses. We've had the pleasure of having a number of them as clients over the years. And there are some sophisticated techniques out there to transfer ownership down to, say, the next generation. And you'll see people use various complex gifting strategies, or GRATs, which are grantor retained trust. In some cases, some annuities are set up. A third party, that would be your typical private equity firm or strategic buyer. Third, you can sometimes restructure or refinance the business to pull out value or re-leverage the business, or even sell a minority stake. So that would be another option. For employees, many of you have probably heard of ESOPs. Baird actually is an employee-owned firm, but we are not an ESOP. ESOPs are great, and I'll have a few words about them later. They're really great in the right situation. In the wrong situation, they're not so great. So you have to be careful about that. They do have significant and very valuable tax benefits. So something to consider in the right context. Liquidation is always possible. And again, some businesses might be worth more dead than alive. Sell to co-owners. One thing I think is important is to regularly review sort of the stock buy-sell agreement, and we often see those agreements out of date or not properly funded with insurance and some of those things. The last option on this slide is an IPO. In our market, the lower middle market, which we consider businesses that are kind of valued in the 5 to 100 million, it's not usually a feasible option because the companies are generally not big enough. But the IPO market has certainly been hot recently. So more than 50% of all businesses owners would like to transition their business to a family member. Only about less than a third actually do that. And why is that? One is value gap. In many cases, there's a disconnect between what the owner generation wants out of the business and what the next generation of owners can pay or wants to pay. There's often a talent gap. It is not always the talent of the people that formed the business and were motivated to do that doesn't always exist in the next generation. And I've seen several examples of situations where business owners put their children in charge of the business when it probably was not the right decision. Of course, 2020 hindsight can show a lot of things. So it's just important to make sure that the dynamics of the family can address both the capability as well as the financial concerns to make everything work successfully to the next one. So how do you do a family transfer? Typically, you'll see some stock gifting. Another technique you see attorneys and tax professionals use are what are called self-canceling installment notes, and GRATs, or grantor retained annuity trust, as well as family limited partnerships. These are pretty sophisticated planning techniques, and it certainly requires very knowledgeable professionals, tax attorneys and CPAs, to make sure those are set up right, the documents are drafted right, and they are reported correctly. Sell to other owners. If you have other partners, partner might be your most logical buyer. Again, a well-prepared buy-sell agreement that is up to date is critical. One of the big issues you see is funding the purchase. And typically that is done with some form of life insurance. It's important to make sure that the amount of the insurance stays current with the value of the business, because you want to make sure that there will be sufficient funding. A buy-sell agreement without funding doesn't accomplish, at the end of the day, the goal. So I'm going to turn a little bit and talk about third-party buyers. There are two types, basically. The financial buyer on the right is what you would think of as a typical private equity firm. The strategic buyer on the left would be your competitor, your supplier, an adjacent company, or someone like that. There are the deals look different in most cases. And there is another type of buyer that sort of fits in between these two columns, and that would be the financial buyer, private equity firm that has a portfolio company in place. So it has some of the attributes of financial buyer, but it also has some of the attributes of the strategic buyer, because it can clearly pay a premium to synergies and savings. A lot of the companies that we advise in a sell-side M&A process go to private equity firm portfolio companies. In a lot of ways, we think in the lower middle market, they're one of the best buyers, because we know they have the financial wherewithal, and they also have the ability to pay a premium. So from a seller standpoint, those are two, really important things. Now, they all have their pros and cons. The strategic buyer can give you immediate liquidity. In some cases, there might be a tax-free exchange possibility. They can pay a premium, and owners get a lot of cash. Some of the negatives are you have very little control of your business after close. The operating autonomy continues to go away, and the company is likely to undergo some significant culture change. Integration can be tough, and sometimes the employees and customers are not 100% happy. Now, the flip side can be true as well. Hilliard Lyons being acquired by Baird was great. I can tell you the Hilliard Lyons employees love being part of Baird, and I think it's probably true of our clients as well. So it can go both ways. Financial buyers typically will require some rollover equity, so you don't get all liquidity at closing. But we've had clients make more money by rolling equity and participating in the long-term ownership of the buyer company backed by the private equity firm. So they can also work great. There are not as many synergies and cost savings, so you tend to not get maybe the premium price that might be available, even though prices certainly in this market have been great. And there is typically a greater ability to participate on the board and sort of have some role in the business going forward, if that's what the business owner is looking for. I'm going to probably move on from this slide a little bit because I covered that some way, but we do think of private equity recapitalization is certainly can be a very favorable transaction for a business owner. Let me talk a little bit about ESOPs. It's a complicated subject. I can reduce my advice in a long sentence. One, if done correctly, and you have the right professionals, and you have an employee base that will truly appreciate long-term ownership, I think an ESOP can be a great transaction and a great result. The beauty of an ESOP is they have significant tax benefits. You essentially can purchase the business out of its future earnings pre-tax. There are not a lot of great tax arrangements today, but an ESOP, if you think about it, it's a qualified retirement plan. So think like 401k, but instead of owning stocks and bonds, in the account, it owns the stock of your employer. Now, an ESOP can make an S corp election, so it does not pay federal and in most states no income tax, and the ESOP plan is a qualified plan, so it is not a taxable entity. So the future earnings of the business are not taxed. There's no tax essentially on that until employees start liquidating their interest in the ESOP. It makes sense, again, where you have a employee base that will appreciate ownership, one, and two, is the company has to be big enough. ESOPs are complicated. They're expensive to set up. It's not uncommon for all of the transaction costs in an ESOP to range from 400,000. I've seen them as high as $1 million. So it is can be expensive to set up, but that's sort of the price you pay for some of the compelling tax benefits. So it's not an area where you want to cut corners. You have to dot all your I's and cross all the T's and make sure. But again, if done correctly, they can be in the right situation, they can be great. Where I see problems is when the transactions are done in situations, one, they're just trying to get the tax benefits, and two, they're done in situations where the employees don't really care about ownership and would prefer to have another $1 or $2 an hour instead of the stock that they can't spend or eat. And I've seen some great ESOPs and I've seen some terrible ESOPs. So enough on that. A little bit of a summary here on the next page, trying to pull everything together for you. And with that, I'll just sort of conclude it again and say the Business Owner Solutions team at Baird is here to help support our financial advisors and their clients and relationships with respect to their lower middle market businesses. So if there are any questions, don't hesitate to reach out to us. We're always happy to have a conversation and give share our thoughts. So even if it's not something that we can really help with a project, but we have a lot of experience on the team, and we sort of understand this lower middle market business world. So with that, Justine, I'll shut up and open it up for questions.
Great, thank you, Andy. I see a couple of questions coming in already, which is great. I'll give you a moment to catch your breath, and we'll remind everybody that if you'd like to ask a question, please do so via the Q&A box on the bottom right-hand side of your screen, and then address your question to all panelists. And so with that, I'll start with the first question. If both the acquiring and the acquired companies are one-person owners, can a pre-tax employer-funded pension plan be used to fund the purchase price?
I'm going to have to defer to a tax expert on that, retirement plan expert. It's a really good question. It's probably a little too technical for me. And I am not a tax expert, so but it's a good question, and I think the right tax attorney or CPA could certainly answer that question. So sorry, I have to punt on the first question.
However, we'll try the second one. This individual owns a small S Corp and has negotiated a stock redemption agreement. Since S Corp must distribute net income to shareholders, where would cash come from to buy treasury stock from the owner?
good question. I really probably need to sort of see the structure. I'm assuming that there's not cash built up on the balance sheet, but it's in the second, I guess the second area to explore would be to what extent could the company borrow money to satisfy that need, cash liquidity need, if they have the borrowing capacity to do it. So in essence, you would use the assets or the cash, flow generated by the business as collateral for a loan.
Excellent, thank you. Next question, maybe a little bit easier. Can you remind us what is the parameters of your little market? You talked about lower middle market is where you guys really specialize. What are those parameters again?
So we typically work with businesses that are valued somewhere at the low end around 5 million and at the high end around 100 million. We have certainly done transactions larger than 100, but that's sort of the heart of our market. And we principally work in about 5, I would say, industry sort of verticals or categories, and that would be industrial type businesses, which would be manufacturing and distribution, business services and technology, which would include various sort of service related businesses, including like software businesses, healthcare. We've done a number of healthcare related transactions. In fact, we just closed a gastroenterology practice transaction about a month ago. And what am I missing? But the simple answer is just reach out to us. If we think we have the expertise and would be successful in a project, then we're more than happy to help. If we don't think we will be, we will endeavor to get help the client find someone who would be the right match. So that's the simplest answer.
Great, thank you. The next question, have you seen any unusual deal structures for third-party sales outside of cash plus seller financing? For example, contingencies on profit sharing, rent on real estate, advisory fees, etc.
Well, you see all kinds of things. And we did work on a transaction where all of the real estate was sold to a REIT independent of the sale of the business. So the real estate was carved out, and the operating business we sold to a private equity firm. So those situations tend to be very, context specific and kind of understanding what assets are involved and whether they can be used as collateral or sold to a third party to generate some liquidity, and what are the other objectives of the owners to accomplish. So happy to have a conversation about that, see if we can be creative with some ideas. So.
Great. The next question. This individual has an S Corp with 2 partners. One partner has 2 children active in the company, interested in purchasing the business. The other partner isn't as much about preserving the legacy of the business to the 4th generation as about the selling price. Would you be able to use an existing buy-sell to possibly begin the process, or what would you need?
I think we would probably want to start and understand the business, and if there is an existing buy-sell agreement, obviously that becomes real important because that sort of defines the the responsibilities and the rights of the various parties. And then determining value would be, more of an exercise of, looking at the financials and understanding the business to generate value. But the buy-sell agreement can cause very different outcomes based on their specific terms. So it becomes really important to understand that.
Great, and as we talked about, there's not a lot of simple solutions to these questions. What is the best way to get in contact with you or your team?
There is a business owner solutions toolkit on Baird Web, and that's probably the best place to start. But you're always welcome to email or pick up the phone and give us a call, and we're always happy to have a conversation and help sort of sort through next steps and whether or not what assistance we can provide, and to the extent we can't, provide some ideas of where to go for some advice in that regard. So I would say start at the toolkit and then go from there.
Excellent. And just to add a little bit of color, the toolkit that Andy's referencing, your Baird financial advisor can certainly get access to that, and then could also tie in Andy and team. And so for those on the line that aren't sure on that piece, I think also the best step is just reaching out to your Baird financial advisor, and they'll certainly get in touch with Andy and team and can set up a discovery call and dig in a little bit deeper.
Thank you. Great answer.
Just an addition. That's the.
Yeah.
Well, with that, I would like to thank everybody for their time today. Certainly, Andy, for your candor, your comments, your insight on this topic. For those of you who'd like to review today's presentation or share it with a friend, family member, colleague, we have recorded the session, and it will be made available about a week following the call, so mid next week to late next week. And you can get the recording through your financial advisor as well. If we were not able to address your question or you wanted to have a conversation offline, again, I think probably the best option might be to reach out to your financial advisor, and they'll plug in Andy and team to set up that call. With that, thank you everybody for your time. Andy, thank you for joining us in your time as well, and everybody have a wonderful afternoon.
Thank you, Justine.